Welcome everyone to today's webinar, proudly brought to you by ADDX. My name is Darius Liu. I'm the co-founder and COO of ADDX. And today in the studio with me is Tan Hak Kim from Fullerton Fund Management Company. Welcome, Hak Kim, to the studio.
Thanks for having me.
Now, today's webinar is entitled An Inside Look into the Private Markets Investing World. Now, strong parentage, exclusive access to top-of-the-line fund managers, and experienced investment team. Now, these are the critical key factors that investors should look out for when investing and navigating through the complex world of private markets. Now, we're very happy to have Hak Kim from Fullerton Fund Management Company, FFMC, with us in the studio today to give us an inside glimpse into how dynamic asset allocation and diversification through a fund of funds approach can benefit investors over the long term. Now, Hak Kim is an investment veteran through and through. He is the head of alternatives and sits on FFMC's investment committee. Previously, he worked with Credit Suisse Customized Fund Investment Group as a partner on its global investment committee, managing and investing PE assets on behalf of investors all over the world. And prior to Credit Suisse, he was heading up Asian fund investments at Schroders, and before Schroders, he was an associate director of private equity funds at Hermes Private Equity. Hak Kim is a GIC veteran, Government of Singapore Investment Corporation, where he was in the special investments division, involved in investing in private equity funds and co-investments in Europe. Welcome, Hak Kim, to the studio.
Thank you so much. Thanks for having me.
And once again, my name is Darius Liu. I'm the co-founder and COO of ADDX. ADDX, as we all know, is the world's first integrated issuance, custody, and trading platform for digitized securities. And we are very proud to be able to bring our users in the exciting private market investments across multiple asset classes. So do join us at www.addx.co, that's addx.co, and find out more about ADDX today. Now, without further ado, I'm going to launch straight into today's webinar. Hak Kim, I'll just start off with the first question. Can you share more about Fullerton and its history?
Sure. I would say Fullerton Fund Management Company is an Asia-based asset management house. So we are very focused on investment outcomes and obviously enhancing returns for our clients. And we are very privileged to have very good quality clients with us as well. Ranging from sovereign wealth funds to government entities to pension funds as well as insurance. With that, obviously, we take our fiduciary duty of making sure that the capital is well invested very seriously. We have the whole suite of asset classes ranging from equities, fixed income, treasury, multi-assets, as well as obviously alternatives. In terms of history, I think many people may not know this. Fullerton started out as a department within Temasek. And it was spun out in 2003 to become an independent asset management house. And I think over the years, we have grown significantly, both in terms of AUM, as well as the number of clients that we manage capital for, and obviously our offices. So we have offices ranging from Asia all the way to Europe and London.
Thank you, Hak Kim. Now, you mentioned that Fullerton has solutions for its clients across multi-asset classes. Now, how important is having a private equity allocation in a portfolio for investors today? Is it adequate to just have, public markets investments in your own portfolio?
Well, how much time do we have? I am biased, of course, being from the private equity side of things. I have obviously advised a number of entities in terms of their private equity allocation, private markets allocation, and I have always said that it's very important to maintain a exposure to private equity because the inherent advantage that private equity has for your portfolio is very important. Number one, it obviously gives you an alpha. I think empirically, a lot of people know that private equity obviously delivers alpha to your portfolio, and not that withstanding, it has a reduced correlation to the public markets. And so I think in terms of adding private equity, I always tell people that you do need to have a 10 to 25% allocation to private equity for those reasons. But of course, that depends on how much you are willing to sort of accept risk as well. And private equity has a whole wide range of risk factors that you need to consider, from the very low risk, good performing, yielding type of private equity all the way to venture capital, which is probably more on the higher risk side.
Okay, so let's say I'm sold. I need to increase my allocation to private equity. How can investors, for example, like myself or my friends, access private equity investments today?
I would say the number of access points into private equity investments is a lot today. Compared to, let's say, 2 decades ago, I think private equity was a very opaque, very difficult to access asset class. But today, there are many ways in which private investors can actually get hold of private equity investments. Let's start with the basic ones. You can get into private equity just by investing in private companies, right? A lot of us pride ourselves as being able to pick the next unicorn, right? So we tend to go for the venture capital. We tend to look for the growth investments of private companies that are trying to raise Series A, Series B type of investments. So for people who are interested in that, obviously there are venture clubs. There are also a number of platforms in which people can sort of get access to some of these startup companies. But for people who are more interested in, let's say, lower risk and a more institutionalized approach, there are always private equity funds. You're putting your money with very sophisticated investors who know what they're talking about and have been investing in private equity over the many decades. And the third way is obviously through a commingled fund of funds. And that is probably more diversified way of getting into private equity.
Tell me a little bit more about the fund of funds approach that you just mentioned. How is this better than potentially a direct fund investment?
Well, we can approach it through numbers, right? If you invest in one private equity fund, you get exposure to maybe 12 to 15, maybe 20 companies even. So with that one investment, you get access to 20 companies. If you approach with a fund of funds approach, you are taking a portfolio approach to, let's say, 10, 15 funds in total. So that could give you easily exposure to 200 to 300 companies. So in that sense, the chances of finding that unicorn, if you like, is probably higher. And also the chance of getting a dud in your portfolio is much, much lower because you are getting so many investments and the chances of one investment affecting your total returns is not going to be that great. So for people who are not that risk happy, I think it's a very good approach to go through a fund of funds diversified approach.
Okay, so clearly when investing in funds, the key thing is to identify the correct managers, right? So what are some of the red flags that you typically look out for in identifying managers?
Well, I think before we talk about red flags, we need to talk about what are the few key things that we look for in a manager. Then we can talk about the red flags. Number one, I always look for consistency. There are a couple of things that we look for, right? Consistency of returns. We want to make sure that this manager has been performing throughout the years, throughout the cycles, throughout the decades, throughout the different cycles of funds. So that's very important to sort of see that their strategy works through many cycles. Second, we are also looking at the consistency and clarity of the investment strategy. We want to make sure that the manager has stuck to its investment strategy, its investment ethos, to make sure that they have continually stuck to that same ethos when investing. And thirdly, the most important part for me is the quality of the manager. Because one time you are looking at, you're basically putting your money with quality managers who are going to be investing that capital for you over the next 5 years, right? And you want to make sure that these managers know what they're doing and they have been performing at the same rate over time. And you can only do this through a face-to-face meeting and interview with them. So turning to the red flags, what we don't want to see in a manager, all right? Same things again, we are looking for consistency. We do not like managers that are very volatile in terms of their returns. For that, you can go to public markets. But in terms of a long-term investment, you want to see that that manager has been consistently performing. It doesn't have to make sure, you have to make sure that every investment makes good money. But over a period of time, all those investments are delivering in terms of the returns. Second, in terms of the consistency and clarity of an investment thesis, that is very important because, for example, you don't want to see a manager that has been investing in, let's say, platform companies, helping them to grow, helping them to list, and they've made good money with it. And then suddenly for the next fund, they decided to look for unicorns by investing in some startup. That to me is a red flag because it shows that they have veered away from their original ethos of investing, what they've been very successful in, and going to something which is less clear for them. So that's again something that we would look out for in terms of red flags. And thirdly, quality of management. As I said, that's the most important thing for me, because you don't want to see a manager that has huge turnover or unhappiness inside there. Usually it's a sign of things that are boiling underneath that surface. And you want to make sure that these managers are well motivated, well incentivized to manage your capital so that they can return good money.
Very interesting. Now, supposing I'm a first-time investor in private equity, what are some of the limitations in private equity investments that I should be aware of?
Well, I would say that there are quite a lot. Number one, private equity is not your typical investment in public markets, nor is it a mutual fund. So number one thing which I always tell people is that this is long-term capital. So you need to have that patience to wait out the next 5, 10, 20 years even. You cannot expect returns immediately over the next 2, 3 months, right? And there's a long lockup. So your capital is stuck in that fund for the next 10 years, right? It's not an investment which you can get in and out easily. That's number one thing which everyone needs to understand. You want to get the full quantum of the returns, you have to wait the full tenure of that fund. Second thing which I think people are less familiar with is this idea of drawdown capital, right? The investment period is over a period of 5 years. So fund managers typically take the full 3, 4, 5 years to invest your capital. If you've committed $100 to a fund, that capital will not be used in the first day. It will be slowly drawn down over the next 3 to 5 years. So what that means is that you have to earmark that whole $100 and wait for the capital calls to come in. So the fund managers will ask for you this year $20, next year another $25, and then the year after $30. So in the meantime, what do you do with the capital? That's always a question that people have. Third thing that people may not be so familiar with is the J-curve effect. In private equity, again, we come down to the long-term horizon that private equity is. You would invest. When you invest in day one, you're likely to see a dip in your returns in the second year, third year, fourth year, even fifth year. The returns only start to come up from fourth, fifth year onwards. And that's where you see that J-curve. And that's where I always urge people to hold it for the whole 10 years, because that's where you see the returns coming back in the fifth, sixth, seventh year, when the returns are coming from your NAV uptick from the investments that have undergone the transformation, that growth, and the kind of restructuring that the fund managers have done for that company. So those are a few key things which I think people may not be so familiar with, but it boils down to one thing. It's a long-term investment.
Great. Now, you've very succinctly explained to us the idea of cash drag and J-curve. Now, from an individual investor perspective, what are some of the ways that we can get around these effects?
Well, I think to get around that, there are a couple of things. Let's start with cash drag. The key thing is you're sitting there with your $100 and you have to wait for that capital to be drawn down. So what do you do in the meantime? There are several things which a private individual investor can do. One is to actively manage your capital while you wait. So if I put in $100 in your fund, and you've only drawn down $20, which means I have $80 which is waiting there. So what do I do with the $80? I have to put it into safe, liquid investments waiting for drawdown. So that's number one. Number two is obviously you can tenure match your investments. Obviously that requires a bit of more sophistication, putting into, let's say, credit opportunities where you can tenure match it to mature at a certain time, to meet certain drawdowns that the fund manager may call. But of course, nobody has time to sort of do that. And frankly, drawdowns is very unpredictable. So you may not actually know when the drawdown schedules are going to be. Or third is to find managers which are willing to do that part for you, because this active management requires you to be monitoring the markets day in, day out. And there are beginning to be more managers like ourselves. At Fullerton, we do quite a bit of that management of capital while it waits for drawdown. So in that way, we take away the stress of thinking when the next drawdown is coming. Is my capital 100% utilized and all that? So that's very important to sort of know that somebody is taking care of your capital. As for J-curve effect, I'm not sure whether you can sort of do the same to mitigate it out of it. But the point is, I think for J-curve effect, private equity is always going to see some form of J-curve. But what you can do is to mitigate it is to build a diversified portfolio with differing years of maturity, differing years of vintages, so that you smoothen out that J-curve. Another strategy which can sort of do is to pepper in some more yielding type of private market strategies. You may put in, let's say, invest in 2 private equity funds and then put in a private credit with a good yield on it, or even infrastructure returns. So that would help smoothen that J-curve so that you don't see that dip.
Let me zoom out a little bit and look forward to 2022. Where, in your opinion, are the opportunities in the private equity space?
Well, crystal balls are obviously very difficult to find in private equity, unfortunately. But the beautiful thing is that it's long-term investments. So I would say that a lot has not changed. I don't think a lot will be changing in 2022 as compared to 2021. There are still a number of sectors which would remain very resilient to COVID-19. And obviously with Omicron coming on, there's always an unknown factor that's thrown inside there. But I think there will always be those opportunities that we look out for in terms of resilience to COVID. Your healthcare sectors, your technology sectors, logistics, and some of the consumer things which are coming up, back up again. So those things I think would continue to be there. We are looking for more technology transformation as well in some of these sectors. And hopefully the pandemic, hopefully we will be coming to an end of the pandemic and we will be able to see some COVID recovery type of opportunities as well in 2022. But what I'm also very excited about is ESG. We are beginning to see a lot more awareness that ESG is very important in private equity as well. ESG has always been in the domain of the public markets, but for private equity, I think there's an obvious understanding that given that this is a long-term investment, the more resilient investments tend to be investments that have got ESG alignment. And there's that awareness is beginning to build, both in terms of fund managers as well as the investor base. So pretty excited about that space.
Thanks, Hakim. Now, you're obviously a veteran with many, many years of experience in the private equity market. In your opinion, what aspects of the private equity market can benefit from technological advancements?
Well, I think in terms of the investment side of things, definitely the fund managers have adopted quite a bit of a technology to make things more efficient in the due diligence process and so on. And so I think that has been happening for a number of years already. But I think in terms of the access is where I think the technological improvements have been very stark in the last couple of years. And I've got to give credit where it's due. And this is not a paid advertisement or anything, but I think the likes of platforms like yourselves at ADDX has been very forefront in embedding itself into the ecosystem of that distribution side of private equity. What that has done is to commoditize the access of private equity to the individual investors. As said, 20 years ago, even if I wanted as an individual investor, it was not possible for me to invest in some of the opportunities that I saw. But today, I think it's very exciting for individual investors today to have the access to some of the brand names, the top names that you see in private equity, through a platform like ADDX and being able to access the alpha in private equity.
Great. Now, turning to our favorite topic of the month, pandemic, right? What have you learned about private equity markets over the course of this whole COVID-19 saga, and what is going to change when investing in private equity?
Well, I think putting aside the human aspects of it, where the pandemic has obviously taken its toll on economies, livelihood, even lives, public health, I have to say that looking at it very coldly from an investment point of view, I think there has been a number of solid investment opportunities that have thrown up during this pandemic. I think at the beginning of that pandemic, we were all worried about what's going to do to all our investments. But we've quickly seen that over 2020, 2021, a lot of fund managers have taken obviously the opportunity to invest in special opportunities, special situations, some turnaround businesses, and being able to sort of pick up good investments which were maybe slightly cash strapped or slightly affected by the pandemic, especially in technology, SaaS software, healthcare. So those were some of the investment opportunities that a number of private equity managers have picked up on. And I think private equity managers in general, they're smart cookies, right? They have learned from GFC and they have seen what GFC has done to some of the companies. And they have applied those lessons onto the existing portfolio. When pandemic first struck, they were very quick to take a defensive approach to make sure that cash was preserved and so as to be able to endure a long drawn out pandemic. So I think that's where I think private equity managers have done very well. And so looking forward, I think the resilience of some of these companies, that technology focus in some of these companies have shown to us that going forward in pandemic, we need to be looking at the same things again and how that has played a role in sort of making some of these companies strong and resilient.
And if we look further out, like as we exit the pandemic, in the post-pandemic world, what would be the biggest change you would see for the private market investing universe?
Sure, I think as I alluded earlier, I think the way in which investments has been done in private equity has changed quite a bit during this pandemic. If you look at 2020, 2021, these are record years for investments. And we're talking about investing in a time when travel was not possible. There's a lot of restrictions towards travel, and you're seeing a lot of people unable to meet people. As I said, one of the red flags for me is not being able to meet the manager of some of these companies and being able to talk to them directly. Nothing beats a face-to-face meeting when you're doing due diligence on an investment. So they have been making this virtual experience even more livelier. I think a lot of people have been taking to online interviews and due diligence a lot more seriously. That's one. And second, I think there's a bit more localization involved, right? On top of that digitalization, they have also gone localization by having more teams on the ground to make sure that if I cannot travel, there's someone on the ground to make sure that that face-to-face meeting is being taken care of. So I think the pandemic has taught us a lot of things, but it has definitely taught us to be more local and more efficient.
In terms of asset allocation of institutional investors, now, do you see a shift in the way that these investors are viewing private equity investments as part of their overall asset allocation?
Definitely. I would say this has been a process over the last 20 years. It's an education process, and over the last 20 years, I think a lot of people have realized and woken up to the fact that you can actually get alpha by inserting private equity into your portfolio mix. So when thinking about portfolio construction, a lot of people have been saying that they are going to allocate more to private equity or private markets in the whole. If you look at the 2020 survey, I believe the top 3 growing asset classes in the portfolio construction for institutions have been private equity, private credit, and infrastructure. And these are private market assets which have traditionally outperformed the market through cycles. Private equity, as you know, has been outperforming private markets over a period of 10, 15 years. And so I think for a lot of them, they are looking at the predecessors. The endowments, the US endowments were the very first to adopt private equity into their portfolio constructions. And they're allocating 25 to even 50% into private equity. And that has been taken up by some of the sovereign funds, including over here at home. So there is a huge allocation shift towards private markets and private equity in general. So a lot of people are getting more excited about it. especially in this low interest rate environment where the sort of fee compressions and so on, people are asking themselves, where next to be able to sort of get that returns. Don't mistake this. A lot of public pensions are under strain right now because of the aging population. So where can I get that alpha?
And interesting that you should mention low rate environment, because my next question, and unfortunately my last question for today, because we're just about out of time, is this: how has the economic stimulus impacted alternative funds or private equity funds, and do you expect this to continue?
Oh, I'm definitely not the Fed, but I think the government stimulus has continued to create a low interest rate environment. That is good for borrowing, especially if you're looking at buyouts, right? Buyouts would be able to borrow at a very good rate, but it creates a second layer of problem in terms of higher pricing. I think in terms of the cost of borrowing, it has come down. The likelihood of returns being able to be improved due to the borrowing, I think we are seeing a short-term positive news on that front. I don't think we're going back to the GFC period. I think we've got to distinguish between, let's say, a financial-induced disruption versus a pandemic-induced disruption. Because at this point in time, we are looking at a new universe whereby the companies are in itself fundamentally strong. The financial status of many of the economies are also strong. So we are coming off a back of a very strong bull run. So a lot of companies are frankly in a good position to take advantage of this government stimulus, and that presents itself as very good opportunities for private equity to take advantage.
Thank you, Hakim. And thank you, all of us, for joining today. And with that, we have come to the end of today's webinar. And we thank you, Hakim, for giving us an insider view into the world of private market and private equity investments. So stay tuned for more educational webinars from the ADDX studio. And until we see each other again next time, goodbye.